Hi everyone, welcome to this first Q&A session where I'll try to answer your questions in the best of my knowledge. So I have received a huge list of questions and it would not be possible to cover every question. But still, I'll try to answer as many questions as possible. So there are questions across your stocks, mutual fund, insurance and personal finance in general. I've tried to incorporate questions across domains. Alright, let's get started. So the first question is from Pradeep and he's asking, I want to know if it is good option to invest in public sector companies like IRCTC, REC, NTPC, NMDC and GAIL. So it is a very interesting question. If you look at the share price movement of public sector companies, majority of them have not performed well. NTPC is still down more than 40% from its peak in 2008. REC has not moved at all in last 10 plus years. NMDC is down 70% from its peak in 2010. So majority of PSUs have either not moved in last 10 years or trading at discount to their peak in 10 years. So at least from past 10-12 years of share price movement, it is not a wise decision to invest in PSUs. Yes, at current levels, majority of PSUs are trading at very low valuation and it might happen that they move up in the short term. But the question is, can they become consistent compounders in the next 10 years? Well, I doubt. It is because PSUs are owned by government and the goal of government is to work for the welfare of the public. So government decisions are not to maximize the profit but to help the public. And hence, private companies are a better option because they work for the profit. On top of this, we all know how public sector companies operate. Personally, I am not a fan of work culture of public sector companies. So I avoid PSUs. There are already great private companies in the market, so why you need to buy PSUs? Yes, IRCTC is an exception as it is highly profitable company and has 100% monopoly in the Indian Railway ticketing, catering and tourism, and there's a bright growth prospect in this sector. Although there will be a risk of government allowing private players in the sector and that might end IRCTC monopoly. Alright, now let's move on to the next question. So next question is from Karthika Muthu and the question is, what is the best time to sell a stock? Because there are few good stocks which gives 3 to 4x return in 1 to 2 years and after that it doesn't move much. An example is Happiest Mind. So there was a similar question from Peenal Shah and the question is, when we invest for long term, what should be the duration? When is it that we should sell the stock? Again, it is a very common question and a big dilemma across many investors. Everyone wants to know when to sell this stock. This reminds me of one quote from Mr. Warren Buffett. He says, when we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. Now in context with Happiest Mind, today when you look at Happiest Mind, it is very easy to say that it has given 3x or 4x return and after that it hasn't moved much because it is always easy to look at hindsight but it is not possible to decide in the real time. Let's say when Happiest Mind jumped from IPO price of 160 rupees to 600 and let's say you entered at rupees 400. Now you might think that you are getting 50% profit and you could exit. But then Happiest Mind jumped to levels of 1500. If you had sold Happiest Mind at 600, you would have regretted your decision. So in that situation, all I can suggest is that if you are a long-term investor and think that a company has great potential, then you have two options. First, either you hold the stock in spite of 3x, 4x return. And second, you book partial profit. But don't sell the stock entirely. Because if you sell the stock, where will you invest next? And if you want to buy the stock again, then when will you re-enter? There have been cases in the past where companies like Infosys and TCS have fallen badly. In fact, during 2001, Infosys share price tanked from highs of rupees 100 to levels of 36. In that situation, if you had sold Infosys, then you would have missed out on the long-term wealth creation opportunity. So always zoom out and look at the long-term bigger picture. If you still feel that you should book profit, then you can book partial profit, but don't exit completely. And trust me, there is no perfect time for exit. It is easy to look at past data and think I should have exited when Happiest Mind was at 1500, but nobody knew it would touch such high levels. And nobody knew that it would fall 40% after that. And it is applicable for all the stocks. For example, Tata Elxsi is at levels of 6,600. At current levels, it is trading at premium valuation. But there is immense growth potential in Tata Elxsi. It is one of the top companies in electric vehicle software development. So if you sell it today, when will you re-enter? So like I said, if you are tempted, then you can consider booking partial profit but do not exit completely from top quality stocks. Next, Swapnil is asking, how many stocks should be ideally picked in a portfolio for 25 lakh rupees? So in general, you can consider investing in 15 to 20 quality stocks across sectors. So you can pick 3-4 stocks from IT, 3-4 stocks from technology, 2-3 from banking, 2-3 from chemical, 2-3 from capital goods, and so on, and build a portfolio of solid 15 to 20 stocks. Now next question is from Kumeras and Subramaniam. Please, your view on latent view for long-term investment. So I have already covered latent view during its IPO and I recommended subscribing to the IPO. I see bright growth prospect in data analytics sector, and latent view is a pure play player in data analytics. It has a very strong leadership and financially also it is very robust. Now latent view got a very good response in the IPO and was opened at crazy 170% premium. So the IPO price was at 197 and its listing price was 530, and from there the stock went up to a high of rupees 700. So that was 3.5 times jump on the IPO price within no time. And at a peak of rupees 700, latent view was commanding a premium of 150 PE. Now that was exorbitant valuation. And from there, the stock has corrected around 40%. But remember that it is still up more than 100% from its IPO price. And at current levels, it is still commanding a premium of PE of 93. So if you ask me to buy this stock today, I would not recommend, as it is still very expensive. But if you have got the IPO allotment, then it is worth holding for the long term. In the next 10-15 years, latent view should generate good returns. Next question is from Mudit Jain, and he's asking, can you shed some light how to carry out the valuation of a company? What are some widely used tools for valuation? So there are 2-3 simple tools to check the valuation: PE ratio, PB ratio, and PEG ratio. PE ratio is most common tool where you basically compare the share price of the company with its earning per share. At the end of the day, share price moves in relation with the earning, that is profits. Now in an ideal world, if earnings are increasing, then share price should also increase. But in real world, sometimes the share price doesn't move in relation with its earning. So I generally look at the PE ratio to check the valuation of a company. But yes, there is no fixed formula that a stock with PE ratio of 30 would be expensive than a stock with a PE ratio of 20. If a stock has high earning growth potential, then it will command a premium valuation. And that's why I always check the PEG ratio as well, which is calculated as PE ratio divided by future earning growth. But since nobody can predict the future earning growth with 100% conviction, so PEG ratio is also not a foolproof method, but I still use it and it is a good way to check the valuation. A PEG ratio of less than 1 is considered undervalued. And for banking stock, I also look at the PB ratio, which is your price to book value. Next question is from Instagram, and Uma Ganesh has asked how to read an annual report. What do you look for in annual report? So I have covered in depth about how to read annual report point by point in my complete course on money management. Obviously, it is not possible to explain everything in this video, but at high level I can say that I look at the chairman or MD message in the report. Then I look at the snapshot of business where they mention the important KPIs. Then I look at the business breakup in terms of how exactly the company is earning money. Then one important section is management discussion, where I get the idea about the future growth potential and key growth drivers. And I also look at the key risk section of the company. By the way, you can see all these headers in the index of the annual report. That way you don't have to read 300 or 400 pages of the annual report. Now first question in mutual fund is from Bhargav Raju, and he's asking, can you guide us how should mutual fund strategy in investing and how to diversify it? So first of all, please be very clear that when it comes to investment, be it your stock or mutual fund, there's nothing called one size fit all. So a stock or mutual fund that is right for me might not be right for you. It is because every person has a different financial goal and risk appetite. So before you invest in mutual fund, make sure that you understand your financial goals. Why do you even want to invest? Do you want to create wealth for your retirement? Or you want to invest for your children's education? Or you want to invest for buying a home or a car? And then also have an estimate about the duration for the goal. Do you want to retire in the next 10 year or 20 year? Or you are someone who want to retire in the next 5 years? Likewise, figure out when would you need money for your financial goal. It need not be an exact duration, but you should at least have an idea. So once you identify the short-term versus mid-term versus long-term goal, then you should choose mutual fund. For short-term goal, like building an emergency fund, you should never invest in equity mutual fund. Likewise, if your goal is to build a retirement corpus or children education in the next 10 to 15 years, then you should have maximum exposure in equity-based mutual fund. Now within equity, you can have exposure across your large cap, mid cap and small cap. So one of the approach is to break your money in one mutual fund each, or you can simply invest in a flexi cap fund where the fund manager would decide how much allocation to keep in which category. I would prefer a flexi cap option. So what you can do is you can have 3-4 mutual funds where you invest around 50% in index funds like your Nifty 50 or Nifty 100 and invest remaining 50% in active mutual funds like your flexi cap fund. Then you can also have small exposure in the US based mutual fund, and that's how you can have a nice diversification in your mutual fund investment. Now due to time constraint, I won't be able to take a lot of questions, so let me pick one generic question. So this is from your Romeo Akash, and he's asking about Bharat Pay's 12% club. So first of all, please understand that it is a peer-to-peer lending app. It means it takes money from people like you and me and pass it on at higher interest. So basically, your small vendors who do not have a credit history and can't get loan from bank can get loan from Bharat Pay at least, let's say, 15 to 18% interest. So in this process, if you lend money, you earn a higher interest of up to 12%. And the person who borrow money also get a loan which bank would have rejected. And in this process, Bharat Pay also make a good margin. So it's a win-win for everyone. By the way, you get up to 12% annual interest on a daily basis. So divided by 365 days and you get your interest that way. But before you invest your money, you should clearly understand the risk aspect. If you're getting up to 12% interest, then one thing is very clear. The person who is borrowing money would be borrowing at a more than 12% rate. And that process has its own risk of default. Obviously, if it was that easy, then the person would have taken the loan from the bank. But if the person is willing to pay as high as 15 to 18% interest, then it comes at an own risk of default. So as long as everything is going good, it is a great idea. But if the default increases, then it will be a problem. But on the other side, your money would be distributed to multiple people. So that distribution reduces the default risk. So even if you want to go for it, only invest a small amount. So that's it for this video. There were a lot of questions I wish I could answer. But if I get a good response on this video, then I'll continue this series and take up many questions in the coming video. Do let me know if you find it useful and shoot your queries in the comment section. And let me know if you have feedback to improve the session. And you can also explore my course on money management. I'll see you next video. Till then, take care.